Bismillahirrahmanirrahim. Dear students, today we'll start our next lecture, and this is about market efficiency. Uh, as we have already discussed different financial instrument and valuation of these financial instruments, and obviously when you are valuing businesses, we have discussed asset-based valuation, income-based valuation, and and many other concepts of valuation as well. And we have also discussed different valuation of different debt and equity securities as well. Now, as being an analyst or being an investor or being a person who want to lend money, it's very important that we should know the market sentiments and how the markets behave. One of the concept of market is market efficiency. As the name suggests, that we are talking about the market, as the market is a player where buyers and sellers meet each other, and the transaction to take place. But it's very important that there are the fundamentals of market are true in its sense, and they are efficient. As in the financial markets, when we talk about the concept of market efficiency, it refers to how well current prices reflects all available information. Actually the information we are talking about, the securities or underlying asset, and as we have said that the market price reflects the demand of that asset, and the people's sentiment regarding that asset, their approach regarding that assets. So a true market efficiency or efficient market eliminates the possibility of beating the market, because any information available to any trader is already incorporated into the market price. So you cannot any investor or the investor cannot get any abnormal profits, because all the relevant information is already reflected in those prices. And as the quality and quality of information or amount of information increases, the market becomes more and more efficient, reducing the opportunities for arbitrage and above market returns. Like arbitrage is a situation in which a person or a trader purchase something from one market and sell in the other market due to some information gap. But when the market is efficient, the arbitrager cannot gain extraordinary profits or above market returns. uh, when we see it's the market efficiency, actually the main emphasis or main core of this efficiency is the ability of the market to incorporate information that provides the maximum amount of opportunities to purchaser and sellers of securities to affect transaction without increasing transaction cost. Like all the information is already incorporated into that in that security price. So they don't have to search for getting any other information, because they already know that all the information is incorporated in that market price, and the market price will not go up and down due to any abrupt changes in the certain factor. So whether or not a market such as US stock market are efficient, or what degree is actually what degree is the efficient market is our Pakistani market or Pakistani stock exchange is there. These are the most heated topic in our current financial scenario, because market efficiency is very important. And if your market is very efficient, people are willing to invest in your market. Like you cannot, if Pakistani stock exchange market is efficient, so we can attract inflows or FDI from the international scenario, and obviously that investment can be used in our business and affecting our GDP. So market efficiency is very much important. So far is we are talking about the economy, and we are talking about our current growth rate. Now, when we talk about market efficiency, so we'll take an example of a company like NPLS shares are valued at $1.30 Is this value reliable? Like for example, the shares of a company, and when we are seeing its price, so are we confident about that price? Like, is price fair, true, or accurate, as it reflects all the dividend announced by this company, or any other expansion or other opportunities which are being announced publicly are incorporated in that, in these shares? Or when we talk, or and when we put it another way, that how efficient is the stock market at valuing the shares of a company? Like, how quickly information is coming within the market, and how that information is quickly incorporated into the prices of that share. Because when we talk about market price of shares, so it's very important to understand that these prices are determined by the demand and supply forces, like the whether people are willing to buy that shares, or whether mostly people want to sell the shares they are currently having of any company. So whether all these prices are reflecting the true information associated with that company. And it's very important that we are talking about the information that is publicly available, and all the information is available, and this information is quickly incorporated into that price. If that information is incorporated and it reflects all the information in the prices, that we can say that the market is very efficient. As When we talk about an efficient market, efficient market is a type of market in which all the new information is quickly incorporated and into the prices of that shares. And there is no bias thing, there is nothing which can influence that prices other than the information of that company, and the information is quickly incorporated in a very unbiased way. When we look into our current scenario, in a current scenario, we have very sophisticated financial market, and because the information flow is very quick, we have cheap electronic sources of information, we have internet, we have mobile phones, and we have large number of informed investors, the people who are willing to invest in the market. And these investors are available worldwide, and because the funds are transferred electronically, and people can buy shares at any place. So new information is rapidly, like in minutes, not days, incorporated into the share price. So we can say that current financial markets are more efficient than the previous market, because the information flow is very fast, and people are getting information, and the investors are getting information very quickly. So we can say that current financial markets are more efficient than the previous markets. As When we talk about market efficiency, so what is the benefit of an efficient market? Like, we have to understand that why we are studying this efficient market. First of all, the main thing which is very important is the investor confidence. And secondly, the share prices also reflects the performance of director. When we talk about the investor, when as investor is paying money, and he want to have as investment in a very fair price, as when they buy shares. And so obviously it's very important that they should have a confidence that wherever they are investing, investing, that market is efficient, as it reflects all the information of that company. That So if the shares are incorrectly priced, many saver would refuse to invest. Obviously, if there are certain bad impact of that, of a market, and people are aware that that market is not efficient, so obviously the price available of different securities in that market are not correct, and investors are hesitant to invest in that market, because because they are not confident about that market. This seriously reduce the availability of funds, and it can affect the growth of that country, or of the businesses in that country. So market efficiency is very important to gain the confidence of investor. The other important factor or objective of efficient market is that we have because directors are there, and that director are there to manage the whole firm. So their main responsibility is to work for the maximization of shareholders wealth, which can be reflected in the share price. So in implementing a positive net value decision, director can be assured that the decision can communicate market will result in increase in share price. So if the directors do not make good decision, or are very suboptimal decision, then in that case the share price will fall. And all the feedback system of the stock market has a dual function. It motivates the director to maximize share price, whilst provide the early warning sign of potential problems. So obviously the share price can be an indicator of your good performance, and can be a warning signal for your bad performance, or making a or it can reflect the warnings for the consequences of your bad decision. So both are very important. It can ensure the investor confident, as well as it can also reflect the performance of the directors. Now, the efficient market hypothesis. What is efficient market hypothesis? Actually, this hypothesis is assumed due to the behavior of the efficient market, and this efficient market hypothesis states that the prices prices which are prevailing in the market fully and fairly reflect all the relevant information about that company. This means that it is not possible for any investor to consistently outperform and beat the market by using any information that the market already knows. But if there is a chance of luck or any other thing is there, so that can on that case he can get profit, but they cannot outperform the market by consistently gaining extraordinary return, because all the prices which are prevailing in the market totally reflects the all the information which is available of that company. So when the idea actually is based on the fact that the information is very quickly and swiftly incorporated into the share price, but there are great large number of investors are at the upper front, and whenever they get information, this information is already, they will take quick action, and the prices is already adjusted for that information. So any investor cannot gain profit based upon any old information, and also that old information cannot be used for far forecasting or getting any trends for future. But the literature suggests three basic form of this market, three level of efficiency are distinguished depending on the type of information available to the majority investment, and hence already reflected in the share price. So these three um, forms of information can be, or form of market can be a weak form, semi-strong form, or a strong form. Like weak form of efficient market is that market which actually past share price movements are reflected in the current share price. And semi-strong kind of market is that in which all publicly information, including past share price movement and any other information, are reflected in the current share prices. And a strong form of market efficiency is in which all the public and private information about that company is reflected in the current share price of that company. So when we talk about types of different efficiency, in efficient market is actually one in which the values of the share is or not always an accurate reflection of the available information. Man market may also operate inefficiently due to low volume of trade or trade activity. In an inefficient market, some security will overpriced, other will be underpriced, which means that some information can make excess return, while other can lose more than warranted by their level of risk exposure. So first of all, when we talk about weak form of efficiency, so in this type of market, information is actually all past information can be used, or can be past prices of that share is reflected in the share price, and all the price movements are reflected in that. But but this past movement do not help to identify positive net present value of for trading strategy. And uh, and the evidence is that share prices follow a random walk, like when we are talking when we are walking randomly, like we don't know that what would be the next step would like, or if we are not confident about our future. And when we talk about an inefficient market, the inefficient market is that market in which prices of the shares cannot reflect the information regarding that company, or the past price movement, or any other public or private information available for that company. So market, as we can say that all the available information are not reflected in the share prices. So market can not also may also operate inefficiently due to certain low volume of trades and etc. uh, and when we talk about an inefficient market, so inefficient market is a market in which in certain times certain securities are overpriced or are underpriced, in which can suggest that a certain investor can get excess return while other can lose more, which warrant their level of risk exposure. Like that means that there are certain risks, many risks involved with that, because the market price are not true reflector of that company. So, what is weak form of efficient market? When we talk about weak form of efficient market, so in this market, the share prices are reflect all the past price movement of that share of that company. And when we talk about this past share movement, so we can say that past share movement is not cannot be helpful in identifying positive NPV trading strategy, as when we talk about efficient market, so efficient market follow a random walk. Like in 1953, Candle presented a paper, and they examined different share price movement over time, and he concluded that the prices of share follow a random walk. Like there is no trend in that, and they do not follow any trend. And so because whenever this trend there is a trend, so you can predict the future price. But and a random walk is a kind of behavior of the share prices in which they do not follow any trend, and if any trend which is there, it is by chance. So because they follow a random walk because new information consistently come into the market, and they are consistently incorporated in the share price. And nobody is actually confirm about any new information. So this information can be good, this information can be bad. This cannot be predicted. So, and if patterns are identified from historical share price movement, this information become known in the market, and the pattern disappear as the market buys and sells shares according to take advantage of the pattern. So the market is weak form efficient, as the study of the history of share prices cannot be used to predict the future in any abnormal profit way. Now, in a case of semi-strong efficient market, the in a semi-efficient market, the share prices incorporates all the past information and all the publicly available information. Is As when we talk about a semi-form efficient market, it's also weak form efficient, and public information includes past information as well. So share prices reacts within 5 to 10 minutes of any information being released, and rise in response to a certain good news, fall in response to breaking bad news. So in a conclusion, we can say that the stock market is almost semi form efficient. So fundamental analysis, examining public available information, will not provide opportunities to consistently beat the market, because we are not sure about the future information, or not sure about the kind of information come in the market. So this information cannot be used to predict the pattern or beat the market. Only those trading in the first few minutes after the breaking can beat the market. Like, as there are few certain investors which are there, and they have the quick access to that information, so they can take a quick action and they can beat the market, but not everyone in the market. So since published information includes past share prices, or semi form efficient market is also a weekly is also weekly efficient. So we can say this semi form a strong efficient market is also a kind of a weak efficient market. Now, then comes the strong form efficient market. Regarding the information, like in the case of strong form efficient market, the share price reflects all the information available, whether it is public, whether it is private, and even that information which is not being published. So, because the information is available, that's why we can say that this is incorporated into the share prices, and nobody can beat the market by getting extra or abnormal return. So like for example, when we talk about its evidence, so insiders like director of, for example, have access to unpublished information. If the market has the stock form, so they can take little action. The share prices wouldn't move when like for example, news broke about a takeover, as it would have moved when the initial decision was made. In practice they do, like this the company do not abruptly take the decision of takeover or acquisition. It can be done gradually. So the information about the takeover cannot have any drastic impact on the share price, because that information is also always already available to the people, and it has an impact when that the initial takeover decision was taken. So there would be no need to ban insider dealing, as insiders could not make money by trading before news become public. So, and it is banned because they do. So insider trading is banned because it can uh, gain extraordinary return to any people who are have access to inside information of the company. So in the conclusion, we can say that the stock market is not strong efficient, and so trader dealers have been fined and imprisoned for making money trading in share before the news affecting them went public. The stock exchange encouraged a quick release of new information to prevent insider trading opportunities, and insiders are forbidden from trading in their share price at critical time, because they have access to many private information and any other information. So whenever the company is facing any critical time, they can forbid any insider to take or purchase any type of security, or sell any type of securities. Insider dealing or trading, we already know that if the person who has access to the private information of a company, as information that is not available publicly, they can make extraordinary profit or abnormal profit. Stock markets are in this case are not strong form efficient. The like for example, when we talk about an engineer who discovered gold, may buy share before discovery is made public. Or when you the merchant banker who hears a colleague is assisting in a surprise takeover bid, has been known to purchase a share in the target firm. Like, if they have information which is not being made available to the public, they can make decision more accurately and get extraordinary return on that. So a big down in the fair game perception will damage investor confidence, and reduce investment. So to avoid a loss of confidence, most stock market have codes of conduct, like they don't want to lose the public confidence, so they have developed a certain ethical code of conduct. And in most countries they have also developed certain laws to curb insider dealing. When in UK it's even criminal offense. So certain time British legislation tend to be less effective than some of their foreign counterparts. America and France also rely initially on civil laws where the burdens of proof is lower than in criminal cases. So another weapon against insider is trading is to make companies release price sensitive information as quickly as possible. London Stock Exchange has strict guidelines to encourage companies to make announcements to market as early as possible on such matter as current trading condition and profit warning. Therefore, there is a mechanism to force private information into the public to attempt to ensure that share prices are reasonably accurate. A third approach that is used to completely prohibit certain individual dealing in a company share majority at a critical time period. The stock exchange mode, a model code for directors precludes directors of quoted companies from trading shares for a period of 2 months before the announcement of annual results. So the code also precludes dealing before the announcement of the matter of an exceptional nature involving unpublished information which is potentially price sensitive. So if we have laws, we develop laws, or we can release information as quickly as possible, or make certain rules for precluding or prohibiting the or restricting the directors to make the public dealing or make purchase or sale of certain shares before any price sensitive information is released. In this case, we can deal with this insider trading, which can, because insider dealing or trading can shake the public confidence, and and in this case we cannot gain profit, or we can lose potential investment from many potential investors. Now, in the conclusion, we can say that in an efficient market, the investor cannot consistently beat or professional fund manager cannot beat the market by seeing the past information or by seeing the past trends as because that information is already incorporated in the prices. So as long as the market is efficient, the fundamental analysis or any other kind of analysis which can give you patterns in the future is a waste of time, as the average investor can get a reasonable amount of return by only diversifying its portfolio, and therefore by avoiding cost of analysis. This message is also very much important for the people who have placed their fund, millions of dollars of fund in low cost index tracking fund, and they have also realized that which because this type of tracking funds mainly replicates stock market index rather than it's an actively managed fund which tries to pick winners. So making investment in the stock would efficient market is better than investing in those funds. The market paradox, in order for the market to remain efficient, investor must believe that there is value in assessing information, because they access it continuously. The information is reflected in the share price as soon as it is released, and an investor cannot beat the market. So the paradox of the M is that large number of investors have to disbelieve the hypothesis in order to maintain efficient. The continuous collective action of fundamental analysts ensure that market reacts almost instantaneously to the disclosure of new information, and their actions safeguard market efficiency and are self-defeating, and they cannot individually beat the market. Their collective value to the market is that they guarantee its efficiency and continuously take action once the information is getting public. As we have discussed different behavior of our investors and the behavior of the efficient market, we can go through a behavior finance perspective, as behavior finance is actually a field of behavior economics which suggests the psychological influences and biases which can affect the financial behavior of investor and other financial practitioners. These bias influences and biases can also be a source for explaining different type of market anomalies and specify market anomalies in a stock market, such as severe rise or fall in the stock prices. So there are different terms which are used in behavioral finance. Like first of all, one is the herding. This is the concept in which we can suggest that investors chose to buy or sell a certain or particular security because other many other investors are doing so. They do this because they don't have confidence, and they just follow the people, and they do not, and they are not using their own judgmental, and they are following the leaders. So the more people that follow the herd, the more are likely to join, feeling the decision he made is accurate, because many other people are following the same type of behavior. The second concept is stock market bubble, in which where a herd instinct has led to the sharp rise in the value of a share in a particular sector that is unsustainable. This doesn't apply to only one share. Like for example, prices of certain houses also rise when many people want to buy houses in certain areas, or certain times the prices of certain houses decline because people are not willing to buy the prices in that buy their houses in that areas with no reason. So and that is the another case. Like the third case is noise trading. Stock market traders who do not base their decision on professional analysts, who poorly time decision and follow trends. Like this is a kind of behavior in which the traders are not using fundamental analysis or professional analysis, but they follow certain other trends, and which are not properly managed or properly arranged. So loss aversion, this is a kind of behavior of the investor in which they want to avoid investment based upon certain risk, which is may be associated with market loss. um, but they are doing so without considering the analyst information, who suggests that they can get a gain in a significant gain in the long run. This can lead to choosing investment that are safe but low earning, and away from the investment that have high return, higher potential in return in the long run. Then another thing is momentum effect. Once a trend is seen in a share price, the market may become optimistic or pessimistic. Optimistic in a case when the price is rising, or pessimistic in the case when the price are consistently falling. This give an instant to the people, and they try to buy buy shares of those companies which has a certain high trend, and making it a long run trend, which can result in giving an optimistic instant to the other investor as well.